There is a detail almost no one notices when they look at Bitcoin today. It's not in the price, it's not on the daily chart, and it's definitely not in the headlines. It's in the supply that never comes back. More than 90% of all the Bitcoin that will ever exist has already been mined. What remains enters the market more slowly every year, and will slow down even more after the next halving. This isn't opinion. It's mathematics written into the protocol. Now combine that with another rarely discussed fact. While price spends weeks, sometimes months, moving sideways, large amounts of Bitcoin keep leaving circulation. ETFs buy more BTC per day than the network produces. Companies add Bitcoin to their balance sheets and don't sell. Custodians record constant net outflows from exchanges. None of this creates excitement. None of this becomes a trend. Because real accumulation is quiet. And this is where most people get confused. The average investor waits for movement before acting. Those who understand scarcity act before movement, when the market feels boring. This is the key point. Bitcoin doesn't need to rise to become rarer. It becomes rarer simply because time passes. While many wait for a clear signal, the available supply shrinks in silence. That's the foundation of the race that has already started. Not a race for price, a race for position. And once you understand that, the question changes. It's no longer, is it still worth it? The real question becomes far more uncomfortable. How much Bitcoin will still be available? When everyone finally decides it is, there's a massive difference between believing in Bitcoin and acting like you believe. And that difference becomes obvious when you look at who is accumulating and how. While the average investor asks, has it already gone too far? Some of the largest financial structures on the planet ask something else. How much can we still buy without moving the price? MicroStrategy didn't bet on Bitcoin. It turned Bitcoin into a corporate strategy. BlackRock didn't launch an ETF out of curiosity. It launched one because there is suppressed institutional demand. That doesn't want, and often can't, operate like retail. Sovereign funds don't announce purchases. They build positions quietly, over time, specifically to avoid attention. And here's the technical detail that changes everything. Institutions don't do DCA emotionally. They do it by constraint. They can't buy everything at once. Liquidity doesn't allow it. Regulation doesn't allow it. Governance doesn't allow it. So what do? They buy slowly. They buy monthly. They buy on boring days. They buy when the chart looks dead. That behavior leaves traces of a continuous reduction of BTC on exchanges, growth in long-term custody to coins staying idle for years, not weeks. None of this shows up on a 5-minute candle, but all of it shows up in disappearing supply. And here comes the uncomfortable part for beginners. You can still buy the same way they do. Same asset, same rules, same protocol. The only difference is the size of time. They think in cycles. You can think in consistency. And that's why the window is still open. Not because Bitcoin is cheap, but because it is still available. When availability becomes a headline, the game has already changed. There's a strange feeling in the market today. The feeling that you arrived too late. It doesn't come from data. It comes from noise, endless timelines, constant headlines, charts circulating all the time. This creates the illusion that Bitcoin is already everywhere. But when you remove the noise, the real number is shocking, for the opposite reason. Less than 5% of the global population owns any Bitcoin, and among them, most hold symbolic amounts. This is not mass adoption, it's mass exposure. Many people talk about Bitcoin. Few people hold Bitcoin. Now look at the other side of the equation. Maximum supply, 21 million coins already lost. Estimated between 2 and 4 million Bitcoin locked in long-term holders, rising year after year. This isn't narrative, it's arithmetic. And arithmetic doesn't argue with opinion. Every new participant doesn't divide the pie, they compete for the same smaller pie. That's why the question, is it too late, is flawed. Late compared to what? The previous top at the first time you heard about it? Or the moment scarcity starts being felt in real usage? Because there is a point in every cycle when the market stops asking if the asset makes sense. and starts asking how much is still available. That moment doesn't come with a warning. It comes with friction. Buying becomes harder. Not more expensive, harder. Less supply on exchanges, more regulatory layers, more intermediaries, more competition for the same flow. And here's what almost no one says out loud. Beginners don't lose by entering late. They lose by not staying long enough. Most don't fail because they bought Bitcoin. They fail because they left before time did its work. Those who understand the game don't rush. They repeat, they buy, they wait. They buy again. No drama, no urgency, no need to be right tomorrow. Because in this market, advantage isn't prediction, it's sustained position. And once you understand that, the fear of being late starts to fade. Not because price is low, but because time is still on your side. There's a common mistake when people see large players buying Bitcoin. They assume it's a bet. It isn't. Institutions, funds, and corporate treasuries don't enter scarce assets for excitement. They enter for structural asymmetry. Michael Saylor doesn't buy Bitcoin because he believes in price. He buys because he understands three basic facts: fixed supply, growing institutional demand, and an entry cost that rises over time. There's no narrative there. There's a spreadsheet. BlackRock didn't launch an ETF because it became a crypto enthusiast. It launched one because clients want exposure to an asset that cannot be inflated by political decision. Meanwhile, central banks expand balance sheets. Governments roll debt. Fiat currencies lose purchasing power, slowly, then all at once. The key point is this: those accumulating Bitcoin aren't trying to beat the market. They're trying to exit the competition. They don't care about weekly candles. They care about relative position in the future. As Bitcoin matures, the game changes quietly. It's no longer how much did it go up. It becomes who still has access. And this is the uncomfortable part for retail investors. When Bitcoin becomes recognized financial infrastructure, it stops being easy to accumulate, not through direct bans, but through layers of cost, compliance, custody, taxation, and friction. Those who entered earlier don't become smarter. They become less dependent, fewer intermediaries, lower friction, fewer barriers. That's why the Bitcoin race is silent. It doesn't happen on Twitter. It happens on balance sheets, cold storage, and recurring buys. No announcements, no rush, no need to convince anyone. While retail debates whether it's still worth it, those who understand the game ask one question: how much can I still accumulate without drawing attention? And that question has an expiration date. Because in real scarcity markets, the last to notice doesn't buy expensive. They buy when they can no longer buy the way they wanted. And that changes everything about time. There comes a moment in every market when the question changes. It's no longer, how high can this go? Or, what's the next opportunity? The question becomes quieter. Am I positioned or just watching? Bitcoin doesn't demand genius. It doesn't demand perfect timing. It doesn't demand short-term predictions. It demands something far rarer: staying power. Most people don't lose money because they chose wrong. They lose because they couldn't sustain any choice long enough. That's why accumulating Bitcoin feels too simple to be true. Because the real game isn't technical. It's psychological. It's structural. It's about moving through time while the world tries to distract you. Bitcoin doesn't compete with other assets for attention. It competes with forgetting. While narratives rise and fall, while charts go wild, while promises renew themselves, Bitcoin keeps doing the same thing, at the same pace, indifferent to opinion. Block after block, issuance after issuance, scarcity after scarcity. And that creates a brutal asymmetry. Those who start early don't need to be right all the time. Those who start late need to be right almost every time. Not because price is high, but because access becomes more contested. Accumulating Bitcoin isn't about getting rich fast. It's about not falling behind slowly. It's about understanding that in a world of expanding currencies, the asset that cannot expand doesn't need advertising. It only needs time. And time, unlike the market, it doesn't negotiate. If this video helped clarify your perspective, hit like and subscribe to the channel. Here, we don't chase the next hype. We build position before consensus. And to close, answer honestly in the comments. No stage, no rush. Are you accumulating Bitcoin or just watching the race from the outside? Because in the end, time doesn't reward better observers. It rewards those who remain.